So investors are beginning to digest the new tariff rates announced by Washington. And the U.S. payroll numbers came in lower than expected, indicating signs of a slowing economy. So let's go to Gary Schlossberg. He's a global strategist at Wells Fargo Investment Institute. He joins us to talk some more about what's been going on. Gary, thanks for your time today.
Thank you.
So more tariff announcements from Washington. What's your takeaway on how this is playing out on North American markets? What are the biggest sectors you have been watching today?
Well, it's playing out pretty much as expected. We did expect to see tariff increases. They are more drawn out, lumpier. Of course, we've had a series of pauses, more to come on that. But the end result is an average tariff rate. It looks like it's going to be settling between 15 and 20%. That's pretty much in line with what we expected very early this year following the increases. That does create a headwind for the economy. We do expect to see inflation percolating up a bit, weighing on an economy that's already losing momentum. The market has gotten wind of that, of course. We've seen defensive sectors do well today in a down market. We continue to look through those tariff increases, focusing on more of the economically sensitive sectors of the market, along with the areas of the market where strategically we think the outlook is quite good. But all in all, focusing on quality, larger cap, mid-cap stocks in a very challenging or uncertain environment over the next 12 to 18 months.
We have less uncertainty with some of the numbers that have been announced by Washington, but we still don't have deals between Washington and Beijing and Washington and Ottawa. Are these relationships, would you say, the most important, the most complicated as a result?
Well, they're critical. I mean, these are two of the three largest trading partners of the U.S. You include Mexico, which has gotten a 90-day extension as well. And there's still uncertainty as to where these tariffs, average tariff rates, weighted by the importance of each of these countries in U.S. trade, will eventually settle. Our guess at this point is it will be, again, somewhere in that 15 to 20% range overall for the average tariff rate. But it could be in the middle end or upper end of that range, depending on how those negotiations play out with those three critical trading partners. And for perspective, that's compared to a 2.5% tariff rate during the opening months of the year.
What's your read on the U.S. job numbers that came out? We have jobs in manufacturing slipping again. How concerning is the read for you?
Well, the numbers clearly are volatile. There is some concern about the quality of those numbers, but they do fit with the more recent data showing that glide path that we expected for the economy toward a very gradual slowdown has gotten a little more, has gotten steeper, a bit steeper than we were seeing just a few weeks ago. We're still looking for more of a soft patch in the economy rather than an outright recession. And these numbers seem to fit that pattern going forward over the next few months.
Do you think the Federal Reserve announcement, which we got this week, would have wiggled a little bit more in one direction, leaning towards a rate cut, had they had the job information when they made that decision?
I don't think they would have changed policy. There may have been more dissenters within the board. I'm not sure what the individual members are thinking, but there's still concern about inflation moving up and cutting interest rates into rising inflation. The risk there, of course, is that inflation might become more ingrained. That said, the Fed clearly is on guard now with the economy unwinding a little bit more rapidly than expected. You have to believe that the probability of a rate cut in September has gone up, although we still think that's less than 50-50. We're still looking for a single rate cut sometime during the fourth quarter of the year. But clearly, the upcoming data will be critical in that decision.
Gary, what are you doing with your investments on a day like today where we are seeing that drop? Are you picking things up? If so, sort of what sectors are you picking things up in?
I think we're pretty much staying the course on our portfolio recommendations. Again, cyclically sensitive sectors, we're focusing on financial services, taking a more of a strategic view and think that the communication services key to artificial intelligence and the tech sector have very good longer-term prospects, data centers and the like, underpinning the power sector as well. So I don't think our strategy has changed all that much. Although if the trends continue, clearly there's a certain rethink. But if anything, I think they'll just strengthen our view to stay with quality, stay with liquidity, large cap, some mid cap sectors of the market, and underweight small caps, which are really looking for much lower interest rates and a clear sign of a rebound in the economy, which we don't think will occur until sometime next year.
Let me circle back to some geopolitical tension as well between the U.S. and Russia, with Donald Trump making some moves militarily. Are you concerned about that? Are you paying attention to it?
Well, certainly there are no shortage of geopolitical tensions out at the moment. Typically, they tend to be short-lived. We focus on the ones that have an economic fallout. Certainly, as political tensions rise, that increases uncertainty. But the ramifications for the oil market, for the fallout and some of the other big trading partners, allies to Russia, will certainly figure into our calculations. And we're certainly attuned to that, even more so in view of the events of the last 24 hours.